Alrighty guys, what is going up? I hope you guys are all having a great and an amazing day today. Now in today's episode, we're going to be talking about why I will never, ever in a million years buy or invest in mutual funds. So I hope you guys enjoy it, and overall, I hope you guys learned something, because that's the biggest thing about all these videos. And if you guys want to do me a huge favor, make sure you guys like the video if you guys get anything out of it. So now, let's jump into it, roll the intro, let's go. Bam! So now before we actually jump into why I hate mutual funds, let's talk about why people invest in them in the first place. The very first reason why people invest in mutual funds is because they think it's good investment. And honestly, we have been brought up thinking that any sort of investment is good. And I do think investing in mutual funds is better than not investing at all. I want to get that straight. But I do think there could be better opportunities somewhere else in the market. The second reason why people invest in mutual funds is because instantaneously you get diversified into all of the mutual funds holdings by purchasing one share of it. So one share, you get diversified very quickly. And I feel like that's why a lot of new investors like to invest in mutual funds, is because it's simple. You can just relax and let other people manage your money for you. Because we always have this common phrase that the professionals know what they're doing, and in some cases that's 100% true, but most of the time when it comes with mutual funds, these fund holders don't even beat the market. You know, there's the study that 96% of all mutual funds don't even beat the S&P 500, so it would make sense to put your money in the S&P 500 rather than putting your money in mutual funds. Do you get what I'm saying? So here's a quick little stat for you guys. Over 92% of all money managers don't beat the small cap market, which is absolutely insane. These small cap movers, these small cap professionals, that is what they do every single day, is study small cap stocks, can't even beat the small cap market. So if you guys think that you guys are going to be able to beat the S&P 500, think again. It's better to put your money into the S&P 500 in a low-cost index fund that really just tracks the market, and you're going to be getting a whole bunch of exposure. But we'll talk about that. Stay with me. But the very first reason why I hate mutual funds, the absolute worst reason, is because of expenses. Mutual funds have been known to have crazy expenses. The very first expense that you always have to look out for is what you call a load expense. What this means is the mutual fund will charge you a load, is what they call it, to actually go ahead and buy or sell the mutual fund. So on top of commission, on top of the expense ratio, on top of everything, you're gonna get charged anywhere from 1 to 2% every time you buy and every time you sell your mutual fund. So if that's, say you guys go ahead and then that fund performs 10% during that year, which that's a pretty good year. But no, you're gonna get charged that 1 to 2%. So if that's, say they got charged that 2%, you guys now have an 8% total profit on top of the expense ratio. It still brings it down. Now on top of the load, you guys are gonna get hit with an expense ratio. So really what an expense ratio is that is how much it costs really per year for them to manage your account. Now on average, mutual funds have the highest expense ratio compared to ETFs. So I would recommend looking at ETFs that are, a low expense ratio, low cost, and ride them out. So I'm gonna give you guys a quick little stat here. According to the Investment Company Institute, the average expense ratio for an actively managed mutual fund is around 1%. For ETFs, that figure stood at 0.18%. That is crazy. So now you guys can see the huge difference between these funds. But how can that little amount add up long term? So in terms of value, the portfolio with the highest expense ratio will lose out on around 21% of total profits after 30 years. So that is absolutely crazy. Over 20% in total profits you're missing out on due to crazy fees that these funds are charging. Many investors don't understand that there are huge tax incentives when investing in ETFs, just because mutual funds actively buy and sell stock. ETFs don't. They are trackers. So what that means is ETFs track the top 500 companies in the market. If you have an ETF that tracks the S&P 500. But these mutual funds are actively buying and selling stocks. So any profit that you get, you're going to be paying tax on at that end of the year, which is not very good. So you're going to be getting hit with these nasty commissions. You're going to be getting hit with the nasty expense ratio. And then on top of that, one of the worst tax that you guys can hit is the capital gains tax. So my final thoughts, what do you need to understand when investing in mutual funds? Don't do it. It's pretty simple. Go ahead, find a low-cost ETF that tracks the S&P 500 or some of these small cap markets. The reason why is because, one, you guys are going to get anywhere from 10 to 12% annual return, which is really nice. Also, most of these ETFs that I'm going to go ahead and name off pay a dividend. Also, their expense ratios are super cheap, meaning that you're not going to get charged any ridiculous fees to actually hold these ETFs. So the very first ETF that I would highly recommend investing in is ticker symbol VOO. This is Vanguard S&P 500 ETF. Very low cost expense ratio, and it gains on average anywhere from 10 to 12% per year, which is awesome. So you get diversified instantly, you get a dividend, you get all the perks of owning it. Now another one here is ticker symbol VTI, which is the total market fund. So this just tracks the total market. It's a great ETF. Now the last and final one that I would highly recommend investing in is another S&P 500 ETF, ticker symbol SPY. The reason why I love this one is because the expense ratio is great, you get diversified, and you're not stuck with Vanguard, you're with a different company, so you're backed by more money. So I highly recommend ETF investing over any other investment out there rather than stocks, because you always have to, have a nice solid portfolio before you go ahead and buy stocks. I think that's a huge thing that people get miseducated on, is that you just go ahead and buy stock. But I'd rather see you guys invest in these low cost ETFs. I think it's a great way for the beginner to actually go ahead and make some money in the stock market. So that is it though. I hope you guys enjoyed the episode, and I have some really cool news. We're going to be creating a course. I haven't really started it yet. Wink, wink. I haven't really started it yet, but we're going to be going ahead, creating a course, really just talking to you guys about investing, some of the tax incentives, some of the strategies that I use to really maximize my investing. So, that is it though. Get ready for that. That's going to be coming out within the next couple of months. I just wanted to get that out there for you guys. So we'll see you guys tomorrow in another episode. Remember to stay happy, stay positive, and overall stay safe out there. We'll see you tomorrow. Take care, guys. Bam.